Tom, you were going to talk a little bit about what an at-risk entity needs to report.
Yes, as you say, Laura, an entity that comes through the gateway will move on to step 2, where it will be required to report in its tax return whether it possesses a minimum level of economic substance and provide documentary evidence if that is the case. For these entities, a minimum level of substance is defined by reference to 3 indicators of minimum substance, being the premises indicator, the bank account indicator, and the employee director indicator. All 3 indicators need to be met. It isn't good enough to just meet 1 or 2. It's also important to note that this substance report is an annual tax reporting obligation, so the position would need to be reviewed each year, and the annual substance report must be made by all entities passing through the gateway, regardless of whether or not the entity actually meets the minimum substance test.
Okay, let's take a look at the indicators of minimum substance in a little more detail. What does the premises indicator require?
So the premises indicator requires that the entity has its own premises or has premises for its exclusive use. Whilst for many entities this may be relatively easy to satisfy, I think the key difficulty is likely to be the requirement for exclusive use, which would seem to preclude the sharing of premises. It's also not clear at the moment whether an entity can make use of premises owned or occupied by another group company.
That's interesting. What about the bank account indicator?
So the bank account indicator requires that the entity has at least one active EU bank account. Each entity will therefore need its own individual bank account, but it is helpful that whilst the account must be in the EU, it doesn't necessarily need to be in the member state where the entity is resident. I think the most difficult part of this indicator is probably the requirement for the account to be active. There's no definition of active in the directive, but some light is shed on its meaning from the list of documentary evidence that the directive says must accompany the annual substance report. This list includes details of any mandates granted to access the bank account and evidence of the account's activity. And this would seem to suggest that, at least to me, that cash needs to move through that account in order for it to be deemed active.
That's really interesting. So it's going to be unlikely to be enough to simply open an account and make a cash deposit. What about the final director or employee's indicator of substance?
Yes, so this one is actually really 2 different indicators, one covering employees and one covering directors, and only one of these indicators needs to be met. So looking at the director one first, the director indicator requires that the entity has 1 or more directors who meet the director conditions, and the director is resident in the same member state as the entity or within an appropriate distance.
I see that an appropriate distance means that the director is no greater distance from that member state insofar as such distance is compatible with the proper performance of their duties. What I wonder is what this means in the age of home working, where individuals can potentially perform their day-to-day duties from almost anywhere in the world. Either way, it's certainly helpful that the individual doesn't need to be in the entity's member state. You mentioned that the director must also meet the director conditions. What do these require?
Okay, there are 3 director conditions. First, the director must be qualified and authorised to take decisions in relation to the activities that generate relevant income or in relation to the entity's assets. Being qualified is not defined in the directive, but the EU's commentary on the directive says that directors' qualifications should be such as to allow the director to have an active role in the decision-making process. And evidence of the director's qualifications and authorisations will need to be provided with the substance tax return filing. The second condition is that the director actively and independently uses this authorisation on a regular basis. This condition, I think, may be the hardest to demonstrate in practice and is likely to require an element of qualitative decision making from directors. That is, in the case of holding companies particularly, the directors of that company should really apply their minds to whether the decision is in the best interest of the entity and not slavishly follow the orders of a parent. Interestingly, the director does not need to provide any specific documentary evidence to confirm this condition. And then finally, the third condition is that the director cannot be an employee or director of an entity outside of the Shell's group. I think this condition is really designed to prevent so-called professional directors from meeting the test. And whilst the concept of group is quite widely drawn, covering any associated enterprise, you can see that it could cause some practical difficulties. For example, if a director is also a director of a family or personal company, which is clearly not part of the Shell's group, I can see that that might cause them to fail this condition.
It's also not clear to me whether employees of asset managers, so investor directors, would qualify, although they may do so if the asset manager is treated as being an associated enterprise by reason of having significant influence over the Shell. Overall, the director indicator looks like it might be the hardest indicator to satisfy, particularly given the focus on qualitative decision making. You mentioned that there was an alternative employee indicator. Is that any easier to meet?
Potentially, yes. The employee indicator requires that the majority of the entity's full-time equivalent employees are resident in the member state of the Shell or within an appropriate distance, and they are qualified to carry out the activities generating relevant income. In some ways, this condition is quite similar to the 5-employee gateway exclusion we discussed earlier in the context of the gateway, although there are a couple of notable differences. The first is that there's no minimum number of employees required, although I think for a majority to be deemed suitably qualified, the entity probably needs to have at least 3 employees. And the second thing to note is that the employees do not have to exclusively carry out relevant income generating activities. They only need to be qualified to carry them out.